Imagine two brothers, Adam and Zane. Same age, same job, same salary. Both decide to invest $500 a month into the stock market. 10 years pass. Adam's portfolio is worth $82,000. Zane's? $89,000. They meet at a cafe, confused. We bought the same index, Adam says. Same companies, same strategy. Zane shrugs. Yeah, but I used ETFs. This isn't fiction. It's a quiet reality playing out across millions of portfolios. Two identical paths, but one is slightly faster, cheaper, and more tax efficient. Most investors don't even realize they're choosing between them. This video isn't just about definitions. It's about understanding the subtle differences that compound over time. If you've ever wondered which one builds wealth faster, or which one fits your style, stick around. Because by the end of this video, you'll know exactly which twin you are, and how to make your money work smarter. Let's start with the basics. Both index funds and ETFs are baskets of stocks, like a shopping cart filled with the same groceries. They track an index like the S&P 500, meaning they mirror the performance of the market. Index funds are traditional. You buy them through a broker or retirement account, and they're priced once a day, at market close. Think of them like a slow-moving train. Reliable, steady, but not built for quick turns. ETFs, or exchange-traded funds, are newer. They trade like stocks, meaning you can buy and sell them throughout the day. They're priced in real time and often come with lower fees. Picture a subway car, fast, flexible, and built for active movement. Both are passive investments. Both are diversified. But the way you interact with them, and the costs you incur, can be very different. And those differences matter more than most people think. Before we dive into the differences, let's acknowledge what makes these two twins so alike. Diversification. Both spread your money across hundreds of companies, reducing risk. Low fees. Compared to actively managed funds, both are cheap. No high-paid managers picking stocks. Market tracking. They don't try to beat the market, they follow it. That's why they're called passive investments. Long-term growth. Historically, both have delivered solid returns over time. Imagine two climbers scaling the same mountain. One uses a rope and harness, index fund. The other free climbs with precision gear, ETF. Same goal, same path, just different styles. This shared DNA is why many investors confuse the two. But once you understand the subtle differences, you'll see how choosing the right one can align better with your goals, habits, and even your tax strategy. Here's where the paths start to diverge. Index funds are priced once per day, after the market closes. You place your order and you won't know the exact price until later. It's like ordering a meal without knowing the final bill until the waiter returns. ETFs, on the other hand, trade like stocks. You see the price in real time, place your order, and it executes instantly. You can even set limit orders or stop losses. This matters if you're someone who likes control. Want to buy during a dip at 11:32 a.m.? ETF lets you. Index fund doesn't. Visual metaphor. Two investors at a market. One waits for the daily price board to update. The other negotiates live with vendors. For most long-term investors, this difference isn't critical. But if you're tactical or just want flexibility, ETFs offer a level of control that index funds simply don't. Fees are like termites, small, silent, but over time they eat away at your wealth. Index funds often come with slightly higher expense ratios. Why? Because they're usually sold through mutual fund platforms, which have legacy costs and minimum investment requirements. ETFs tend to be leaner. They're built for efficiency, often with lower fees and no minimums. You can buy just one share, like no need to commit $3,000 up front. But there's a catch. ETFs may involve trading fees depending on your broker. Some platforms charge commissions, others don't. Visual metaphor, two houses. One has a slow leak in the roof, index fund fees. The other has a toll gate at the front door, ETF trading fees. Over time, these small differences can add up. Zane's $7,000 advantage over Adam? Mostly fees. So if you're fee sensitive or just want every dollar working for you, ETFs often win this round. Taxes are the silent partner in every investment. And ETFs have a clever way of keeping Uncle Sam at bay. Index funds can trigger capital gains when the fund manager buys or sells shares even if you didn't. These gains get passed to you and you pay taxes. ETFs use a mechanism called in-kind redemption. Without getting too technical, it means they can swap assets without triggering taxable events. It's like trading cards instead of selling them. Visual metaphor. Two investors at a swap meet. One sells items and pays tax. The other trades silently, no tax involved. This makes ETFs more tax efficient, especially in taxable accounts. In retirement accounts, like IRAs, the difference doesn't matter. But in regular brokerage accounts, it can be huge. So if you're investing outside of retirement and want to minimize taxes, ETFs quietly take the lead. Let's talk about who can actually invest. Index funds often require minimum investments. Sometimes $1,000, $3,000 or more. That's a barrier for beginners or those investing small amounts monthly. ETFs are more flexible. You can buy just one share. If it's $42, you're in. No minimums, no waiting. Visual metaphor, two doors. One has a velvet rope and a dress code, index fund. The other is open to all. Sneakers welcome, ETF. This accessibility makes ETFs ideal for dollar cost averaging. Investing small amounts regularly. You can automate purchases, build positions over time, and stay consistent. For beginners, this matters. The easier it is to start, the more likely you'll stick with it. And in investing, consistency beats perfection. So if you're just starting out or want flexibility, ETFs make it easier to begin your journey. Now that we've compared the specs, let's talk about personality. If you're hands-off, prefer automation, and invest through retirement accounts, index funds might suit you better. If you want flexibility, control, and tax efficiency, especially in taxable accounts, ETFs are likely the better fit. Visual metaphor, two travelers. One books a guided tour, index fund. The other rents a car and explores solo, ETF. There's no universal winner. It's about alignment. What fits your habits, goals, and account type? Some investors even use both. Index funds for retirement, ETFs for taxable accounts. It's not cheating, it's smart strategy. So ask yourself, do you want simplicity or control, automation or flexibility? Your answer will guide your choice. Let's return to Adam and Zane. They both invested in the same index, but Zane's ETF gave him real-time control, lower fees, and better tax efficiency. Over time, those small advantages compounded. Visual metaphor. Two runners finish the race. One is slightly ahead, not because he ran faster, but because his shoes were lighter. The truth? ETFs often win by inches, not miles. But in investing, inches matter, especially over decades. That said, index funds are still powerful. They're simple, automated, and perfect for retirement accounts. So which one wins? The one that fits your journey. Now you know the difference. You've met both twins, and you're ready to choose your path. Not just based on hype, but on clarity. If this helped you, consider subscribing.